What's up guys, I'm Mike from StockedUp. In this video, I'm going to be showing you how to put yourself in positions where you can risk $8 to make $242 using options. So this is pretty much the exact opposite of a straddle, and this is called a long iron butterfly. So with straddles, we never want to straddle when implied volatility is high. So this is the exact opposite. So in this video, we're going to be looking at long iron butterflies and just pretty much how they work and how you can get some great risk-reward setups. Now, Boeing, we're looking at Boeing because the implied volatility is high. You'd only want to use this strategy on plays where implied volatility is high, because if you don't, then you're not going to get these types of risk-reward setups. So you would not want to do this on McDonald's because IV is low. You would not want to do this on SPY right now because IV is low. But Boeing is a good situation for this week because IV is high. So pretty much what you do is you pick the at-the-money strike price, and so like right now Boeing's at $337. So for this example, we would use the $337.50 strike. So what you do is you sell the $337 strike call, you sell the $337 strike put, and then you buy the put below that, so that would be the 335 strike put, and then you'd buy the call above the 337 strike call, so that would be the 340 strike call, and you could see that you'd get a credit of $242 for doing this, and the width of the strikes is $2.50, and you know that because do 340 minus 337.5, so it's just the width of those strikes. Pretty much at the end of the day, the name sounds complicated, long iron butterfly. The only thing is that it's a put spread and a credit spread with the same strikes. It's really that simple. So if we go to the Analyze tab, we can see that we just see like the risk reward setup. So we could see that we risk. So if we bought 10 of these, we would be risking $80 to make maximum to 2,400. Right? Yeah, 2,400. Yeah, about 2,400 bucks, 2,420 bucks. It's not bad. Obviously the risk reward is really great. The only thing that is bad is that it's not binary. So it's not like you either lose 80 or make 2,400. It's like you could lose 80, you could lose 60, you can make 60, you can make 100, you can make 200, you can make 1,700. The only way to make max profit is if the stock expires at the strike price you have listed. So for example, the only way you're going to make money on this the only way you're going to hit max profit is if Boeing is at, If Boeing is at $337.50 by expiration. If it's at like $338, you would make about $1,500. So the closer you are to the actual strike prices that you sold, the more money you're going to make. Now, if you want to get a little bit more sophisticated and have some different risk-reward setups, what you can do is so you're going to sell the 337 strike call, you're going to sell the 337 strike put. But instead of buying the put and call right above those strikes, you could go like 2 strikes out. So for example, instead of buying the 335 put, you could buy the 330 put. And then instead of buying the 340 call, you can buy the 345 call. And what this would do is it would put you in a risk-reward scenario where you get a credit of $600 and you would be risking, so we're going to go to the Analyze tab, you would be risking, wait for this to load, okay, you'd be risking $105 to make $645. And the only thing by widening the strikes, what it does is it gives you a higher chance of profit. So instead of needing the Boeing to expire at 337 on Friday, you could have it expire at like 340 and still make money. So like for example, if it expires at 340, you'd make about $300. So it's pretty simple how it works. I've traded a couple of these in the past on Amazon. I wouldn't call them like a consistent strategy, but I've made money on them in the past. For the risk reward, you really can't beat it. Risk 8 to make 242. It's a pretty dang good deal. Like I said, I traded them a little bit in the past, nothing too crazy or too heavy, because it's a more speculative trade. What I am thinking about doing though is with Boeing and like other stocks where the IV is so high and the options are so expensive, I'm thinking about selling the premium on them and then just closing them early. So for example, if I did this trade, I'd get a credit of $645. My max loss is only $105. So if I sell premium on this and just hold it for like 2 days, I'm not going to make 200%, but I might make 30 or 40%, and I'm fine with that. So I'm going to experiment with it, see how it works out. We have a lot of strategies, in the making right now, especially with premium selling with iron condors and put and call credit spreads. So as always, if you have any questions, or more importantly, if you have ideas, we need more ideas for these strategies, let me know in the comments down below. But other than that, thanks for watching.